Congratulations! You've made the decision to explore the Roth IRA conversion. Welcome to the first step to potentially saving you, your spouse, and your heirs an extremely large amount of money. I'm excited to give you a look at your potential savings and a much more lucrative future. This should only take about 20 to 25 minutes of your time and is designed to offer an overview of a proprietary tax strategy we have developed that has the ability to reduce our clients' taxes hundreds of thousands and even millions of dollars over the life of their retirement. Let's get started. One of the biggest complaints we hear from successful investors and retirees is that their current tax advisor does not introduce specific strategies to significantly and permanently reduce taxes. In our experience, most tax advisors tend to work reactively, accounting for last year's taxes as historians, rather than proactively planning for reducing next year's taxes and future taxes. Our clients have taxes reduced by 30 to 45% by using conservative IRS-approved strategies and proprietary investment options only available through Roth IRA. Roth IRA takes a forward-looking approach in our planning process to assist our clients in maximizing wealth and legally minimizing tax liability. This is accomplished by utilizing specific tax-advantageous approaches tailored to each client's unique situation, with a primary focus on creating a plan geared toward long-term wealth accumulation and significant reduction of taxes. Our ultimate goal at Roth IRA is to bring the very best tax and wealth planning resources that the tax code will permit throughout your retirement. You may be questioning whether now is the right time to convert your current IRA to a Roth IRA. We believe this is the absolute best possible time to do so, and in the next 15 minutes or so, I'm going to highlight all the reasons you need to act now. The most difficult aspects of deciding whether to convert your traditional IRA to a Roth IRA is when to realize a tax penalty, and if it makes sense for you and your retirement plan in the long run. At Roth IRA, our tax and financial planning experts take clients through a simple planning process and illustration software that provides a clear comparative analysis and assists you in determining whether utilizing a Roth IRA conversion strategy makes sense now and in the future. For those of you who are unfamiliar with the Roth IRA conversion decision, one could compare it to winning the lottery and deciding between taking the lump sum or an annuity. In other words, you are deciding to either pay the taxes now or at some point in the future. It all comes down to two basic questions. When do you think you will need the money for retirement? And when is the optimal time to pay the taxes? Well, seeing that the tax component is inevitable and can be a moving target with legislation, the real question becomes, is there a way to reduce your tax exposure now? In 1997, a forward-looking senator named William Roth had a vision to attract younger investors to the power of savings and investments. In 1998, Roth was quoted as saying, "It is in the national interest, both for the economy and the family, that we have significant savings." The Roth IRA would soon become a popular vehicle used to accumulate after-tax dollars, which subsequently grow tax-deferred and can later be withdrawn tax-free. However, there were income limitations placed on single and married contributors of the Roth IRA, as well as those looking to convert their 401ks and traditional IRA to this tax-advantaged alternative. Fast forward to 2010, when the IRS lifted the income restriction on Roth IRA conversions, which resulted in a tidal wave of billable activity for CPAs and financial planners across the country. In fact, $64.8 billion went from traditional IRAs to Roth IRAs that year alone, which represented an 800% increase from the previous tax year. Approximately 57% of the conversions during this period were from people with incomes of six figures or greater. Savvy investors and individuals with financial insight or guidance saw this as a great opportunity to reduce their future tax exposure at a time when the effective tax rates were at historical lows. For high-income taxpayers, it's likely that marginal tax rates will not be reduced, but rather will increase in the future. Proposed legislation would not only increase marginal tax rates, but would also make many of the tax strategies we will be discussing here prohibited in the future. Even the Roth conversion itself is being targeted. This is why you need to consider converting now and take advantage of the tax benefits provided to you with Roth IRA's proprietary conversion process. Tax rates are still historically low, and there's much greater opportunity for them to go up in the future. Let's take a look at the rates historically. When you look at the chart, you'll see that in 1944 and 1945, the marginal tax rates were as high as 94%. I'm not suggesting that will happen. I'm simply giving you a historical perspective. The 1950s, 1960s, and 1970s saw very high tax rates also, as they never dipped below 70% in all 3 decades. The Economic Recovery Tax Act of 1981 slashed the highest rate from 70 to 50% and indexed the brackets for inflation. Then, the Tax Reform Act of 1986, claiming that it was a 2-tiered flat tax, expanded the tax base and dropped the top rate to 28% for tax years beginning in 1988. The hype here was that the broader base contained fewer deductions, but brought in the same revenues. Further, lawmakers claimed that they would never have to raise the 28% top rate. Well, the 28% top rate promise lasted 3 years before it was broken. During the 1990s, the top rate jumped to 39.6%. However, the Economic Growth and Tax Relief and Reconciliation Act of 2001 dropped the highest income tax rate to 35% from 2003 to 2010. The Tax Relief and Job Creation Act of 2010 maintained the 35% tax rate through 2012. The American Taxpayer Relief Act of 2012 increased the highest income tax rate to 39.6%. The Affordable Care Act added an additional 3.8% to this, making the maximum federal income tax rate 43.4%. The highest income tax rate was lowered to 37% for tax years beginning in 2018. The additional 3.8% is still applicable, making the maximum federal income tax rate 40.8%. You may be asking, what does all of this mean for you? This history is important because it shows that the tax law is always changing. You must pay close attention to these changes because they affect your bottom line. Most people realize we're going to have to come up with the money from somewhere to pay for those $6 to $8 trillion of coronavirus stimulus payments. And the spending just keeps coming. Let's be honest, tax rates are very low. Our country is in deep debt, and Washington is coming after your IRA savings. Current legislation is geared to severely limit your ability to participate in Roth conversions, and tax rates are going up. This is why it is so important that you pay close attention now to what your options are and the best way to move forward. And this is why you need to act now. When you retire, almost every type of income counts in the dreaded provisional income calculation that determines how much of your Social Security will be taxable and if you'll have to pay the additional Medicare Part B penalties and surcharges. Your $104 per month premium could be as high as $400. Except for income from health savings accounts, 401(h) plans, life insurance loans, and Roth IRA distributions. Do yourself, your spouse, and your kids a favor, and look at what converting now can mean for you. As I have just stated, the current administration has proposed legislation to not only increase federal tax rates, but to also do away with or severely restrict Roth conversions. Now is the time to act. Roth-Wright's retirement tax professionals and valuation experts have developed comprehensive Roth IRA conversion strategies that can save you 30 to 45% in current tax liability, resulting in potentially millions of dollars for you and your family in the long term. Let's take a look at a hypothetical situation. Mike and Lauren were curious about their IRA withdrawal plan, and after sitting down with Roth-Wright, they recognized very quickly that they had a required minimum distribution conundrum on the $3 million they had accumulated between them in IRA accounts. By doing nothing and paying taxes on their required minimum distributions, their lifetime taxes to age 90 would be $3,721,616. This was without changing any of their current investments, which are invested in moderate growth and earning 8.8% interest. In fact, when we look at the chart, we can see that prior to age 72, their total tax liability was zero. But now, take a look at age 72, when required minimum distributions kick in. You will see that their total tax jumped from 0 to $87,117. 10 years later, at age 82, the tax jumps to $211,101. And 10 years later, again, the tax is now $242,487. In that same 18-year period, they paid $3,721,616 in taxes associated with their IRA account. With comprehensive tax planning with Roth IRA, Mike and Lauren were able to save approximately $3 million in taxes, and that has a major impact in their future estate value. By being able to reduce their tax liability by approximately $3 million, we were able to significantly increase the value of their estate by over $23 million. This assumes growth at a rate of 8.8% in their current accounts and also any Roth IRA conversion strategy used. By now, I assume you are asking yourself, how are we able to reduce taxes by $3 million and also have an estate value worth nearly $23.8 million more than not converting and taking minimum distributions? The answer lies in our ability to significantly reduce taxes on the rollover using proven and safe strategies. If we take a look at the 1040 form here, you will see that a straight conversion of $3 million would result in a federal tax liability of $1,155,530, resulting in a huge reduction in estate value and taking many years to make up the difference. Now, by using some approved and safe tax planning, we're able to reduce the tax liability by $444,000, which has significant consequences immediately and for many years to come. Take a look at the corresponding 1040. The only difference between the two 1040s is our ability to use tax-proven strategies to reduce the liability. By reducing the current tax liability and simply allowing the account to grow in a Roth IRA tax-free, we are able to create an estate worth $39,488,542 at age 90. This is $23,796,393 more value than not converting. In addition to the $23.8 million in additional estate value, we would have also saved millions in taxes that would have been paid on minimum distributions. Doing a conversion right now and paying the taxes was a pill they were happy to swallow because of their concern about taxes increasing in the future and the recognition of the fact taxes are low right now and only going to increase. This scenario illustrates the dynamic ability of doing comprehensive tax planning to dramatically make a difference in someone's financial future. It harnesses the power of compound interest, tax reduction strategies, and tax-free withdrawals. When you're ready to learn about these strategies and how they can specifically impact you, we would be happy to schedule a time with one of our tax experts who can share these very specific strategies with you. We're proposing to pay your taxes now and get it out of the way. Our tax experts can show you how to save approximately 40%, and you stay in that nice tax-free account in perpetuity. The tax savings by doing a Roth conversion is even more dramatic when we consider state taxes, which we have not even considered in these comparisons. Consider, for example, someone living in California that is subject to the highest top marginal income tax rate in the entire country at 13.3%. This is where we need to personalize each analysis. At Roth IRA, we will custom tailor each analysis using our tax strategies and taking into consideration each individual's personal situation. For high-income taxpayers, it is likely that marginal tax rates will increase in the future. The Secure Act of 2019 required non-spouse beneficiaries to empty inherited IRAs within a decade of the owner's death. These beneficiaries can accumulate funds in a Roth IRA for 10 years on a tax-free basis. If you convert your traditional IRA to a Roth IRA, you will be providing a significant advantage to your future beneficiaries. Since it is likely that your tax rates will increase in the future, it would be to your advantage, as well as that of future beneficiaries, to do a Roth conversion now rather than later. Here are your 3 key takeaways of tax benefits associated with a conversion now. By converting now, you are locking in today's tax rates, which are much lower than previous tax rates and will almost definitely be lower than future rates. Second, A conversion now will lock in a 0% tax rate on the funds in the account for the rest of your life and your spouse's life, and for 10 years for subsequent beneficiaries. Roth owners do not have minimum distribution requirements, and your surviving spouse also will not have any minimum distribution requirements. So, as long as there is no need to withdraw funds from these accounts, the accounts will continue to increase tax-free. And last, future taxes will be reduced because the funds converted will lower IRA balances subject to required minimum distributions, and accordingly, lower your taxes. It is true that in the year of the conversion, there would be a tax increase. However, avoiding income taxes now is short-sighted, and in the long run, the advantages of converting now outweigh the disadvantages of paying an increased tax in the future. The bottom line is that there are many long-term advantages associated with a Roth conversion that outweigh the short-term disadvantage of the additional tax that will be imposed on you if you do not convert now. Strategies and techniques we have mentioned here that will save you 30 to 45% in taxes on your conversion. So there is no reason to worry about speaking with any high-pressure salesperson that you might get with someone else. Our specialists are in the area of general finance, tax, and retirement planning.